Hey, good afternoon, good morning, good evening. Hope everybody's well. Hope you all had a good week. And if it was a struggle, um, hopefully this week will be better. So I wanted to go over a couple of things. The title of this video is actually going to be, I was thinking about this over the weekend, Trump-induced recession to force rate cut. Before we get into the charts, we're going to talk a little bit conceptually about what's happening in the market, what's going on, what do I think is the ultimate goal, and where do I ultimately think we're going. So there's been a lot of talk the past week, actually not the past week, it's been growing, really growing around on desks across both the country and across the world. And the question that's being pondered is Trump forcing a recession through tariffs to get the Fed to cut rates? That's the question that's being pondered across desks pretty much globally. What do I mean by that? So tariffs to a large extent, um, as we all know, are a tax on the consumer. The importer pays the tariffs, not the exporter. Okay, I'm not going to get really into the economics of that. You're more than happy to Google it, and you can read up all you want on it. However, where it becomes important for us in the U.S. is, and Trump alluded to this last week in an interview on Fox Business on Monday Morning Futures and he said basically that ruling out a recession was not out of the cards. And it's the first time he's ever spoken like this. Trump 1.0 versus Trump 2.0. Trump 1.0, he was very, 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 very focused on the stock market. Nowadays, he is not focused on the stock market at all, like at all. Um, if anything, he's completely ignoring it, and I think he wants it. I think he wants it to go down. Meaning, I think he wants the market to go down. I think he wants the stock wealth effect to get wiped away. I believe that he wants the country to go into a recession, not for the reasons that he wants to hurt people. I think it's the exact opposite. I think the reason why he's doing it is because he wants to force the Fed to cut rates. You'll know, if you were astute and you were paying attention, a couple of weeks ago on a Friday, Powell spoke and he said that the Fed is in no rush to cut rates. Now, you could believe that, you could not believe that. I'm going to tell you my opinion. I'm going to tell you a fact. I think the reason why people got hurt during the Biden administration when it came to rates specifically was because they weren't paying attention. The Fed was very, very steadfast, and they were all unanimous on this. Whether it was Powell or voting members, they kept saying over and over and over again, higher for longer, we're going to raise, we're going to raise, we're going to raise. And no one believed them. Nobody, whether it be stock investors, whether it be real estate investors. Nobody believed, or anything that's interest rate sensitive, cars, whatever. Nobody believed them. And every time that the Fed raised, it was like a shock to the system. Like, what's going on over here? They're going to cut, they're going to cut, they're going to cut. And everybody got this wrong. Everybody. Okay, I'm not going to tell you where I stood on it because it's irrelevant. If you want, you can reach out to me privately and I'll tell you where I was and I can prove it to you where I was, in terms of my outlook and things of that nature. However, the point is no one listened. And then rates got up to 5.5%. And everybody was like, huh? Now rates sit at about 4.5%. The Fed told you before they started cutting that they were going to do four. He was very specific. Data dependent, we're doing four, that's it. They did the four. They got us down a full 100 bips. As far as they're concerned, they did their job. Now they're looking at it and saying, okay, the economy is relatively holding up. We're not really, if you exclude tariffs and you exclude everything else that's being done by the administration, leaving everything at an even playing field, the economy is not falling out of bed. It's painful. It's annoying. I understand that. I get it. Some people are hurting, some people are not hurting. As an overall, the economy is pretty much holding steady. The Fed is not in a rush to cut rates because one of the things that Powell, for those of you that don't know, Powell is not really an economist. He's more of a credit guy. That's really his background. On top of that, his outlook, or his mentor, which is affecting his outlook, was Paul Volcker. Volcker was brought in to the Fed to basically when they got inflation under control in the early to mid 70s. Then it came back. in the late 70s under the Carter administration, and then Volcker came in and basically was a hatchet job to interest rates to get to, and he explode to I'm sorry to inflation, and he basically exploded rates to get inflation under control. The point of that little blurb is that is what Powell is afraid of. Powell is afraid that if they cut too fast and all of a sudden rates explode, he's going to have a repeat of the 70s, and he doesn't want to be that guy. So he'll keep them higher for longer, as long as he can without crashing the economy. Now, where do we find ourselves today? Today, we have a current administration that's basically, to a certain extent, I don't want to say is doing a hatchet job to the economy because it's not, but it's very much focused on tariffs, on getting government spending under control. I just want you to just to keep this in perspective. Government spending and government jobs are two different things. There's a lot of waste in the US government. We all know that. At the same time, a lot of people are going to be losing their jobs, which means the unemployment rate is going to explode higher. Okay. So if the unemployment rate is exploding because of all these government workers that are being laid off, and you have tariffs, that alone is forcing the hand of the Fed. Why? Because the Fed's job by regulating monetary supply is to make sure that number one, prices are stable, and that they can keep employment at a relatively stable level as well. If you have thousands, well, not thousands, tens of thousands of government employees being laid off at the same time that you have prices for everyday goods going up because of tariffs, it's going to force the hand of the Fed. So it could be that the end game here for this current administration is to get the Fed to lower rates. Where do they want rates? My guess is they probably want them 3.5. They're not going to get them below 3. I think 3 to 3.5 is where they want it to go. Whether or not that happens is we're going to find out soon enough. But that looks like that is the end game here, to get the Fed to move rates down. Now, I want to tell you something, and this is going to be something that everybody's going to always say, and I want to give you just a statement of fact. Okay, the Fed does not care about the stock market. Not in the sense that a trader looks at it. The Fed looks at it from a very different perspective. The Fed are not day traders. They're not looking every day, it's up, down. They don't care about that. They're looking that is our market prices going down far enough to cause economic havoc? Are companies losing value where they can't service their debt? Because remember, corporate balance sheets, they have a lot of debt. So are companies running into issues where their stock prices are dropping so low where they're now running into problems running their businesses? Because you have to remember, okay, for most companies, okay, they do not have enough cash to run their businesses on a day-to-day basis. So they rely on bank funding to keep things going. Okay. Even the big monster companies, J&J, McDonald's, what's it called? GM, Ford, just Boeing, to name a few, just companies, Caterpillar. It's not like they're sitting there with all this cash that they can just constantly make their payrolls and other things. They're constantly borrowing and repaying. So they rely on the financial system to keep their businesses running. Okay. Now, banks, to a large extent, don't care if the real estate market kind of starts to go. There's a lot of loans on their books they want to get rid of. Meaning, if you borrowed pre-COVID or you borrowed during COVID, your interest rates are so low that they're losing money on you. So if they can find a way to call in your loan and get a 3.5% loan off their books, they would love it. Why? Because, as you know, banks borrow on the long end and lend on the short end, but they're losing money right now. Okay, banks in general. Now they have, obviously it's unrealized losses, but they are losing money. So if they can find a way to get a lot of this 3.5, let's just say 3.5% loans off their books and then lend it out at 6.5, that's like that. They love it. They would love to do that. Okay. So with all that being said, that's the backdrop that we currently face. So now let's talk about the markets, and we'll go from there, where I think we're going and where I think potentially the pain may stop. Okay. So we had obviously a relief bounce on Friday. Okay. We definitely had a relief bounce. Okay. We are clearly, this S&P cash, by the way, we are clearly below the 200. It's not even an option. Okay. You have the 8, the 20, and the 50, 8, the 21, and the 50. The downtrend is clear. Okay. Now, where could we go from here? We got to about 10% off highs and then we bounced. Okay. Which makes sense because again, as we've mentioned in the past, the algo or the computer is programmed at certain levels to start buying. Now, levels not being price levels, percentages. So a 10% move off of highs, it signifies a 10% correction by definition. The market will bounce from there. Okay. Now, something that the great Peter Lynch had mentioned, which he's right, and when you think about it, it makes a lot of sense. He has said, and he's that you get a 10% move off of highs every 2.5 to 3 years. You get like that kind of move, that 10% correction. So from a timing perspective, we're pretty much in line with normal historical of what should happen. We had our 10% correction. Now, we keep going. Every 5 years or so, we get a 15 to 20% correction off of highs historically. Now, that doesn't mean that it can't happen now. This is just historically what happens. Okay. So, from a historical perspective, as much as it seems scary, so to speak, we're just doing what we normally do. Now, I've mentioned this in the chat a few times. I've mentioned it to a few people, and I'll say it like this. I think I said it last week. It bears repeating. The stock market is the only place that when great companies go on sale, everybody panics and starts selling. They don't look to buy things. Okay. The stock market is designed to go up. Even short term, even 4 years, okay, of a presidency could technically be considered short term. The market goes up over time. It is designed to go up. These are not lotto tickets. You're making investments in companies. You're buying companies. So your expectation is that over time, like any business, the business is going to grow. As a shareholder, you're going to be rewarded for owning a piece of that business, whether it be through dividends, buybacks, regular price appreciation, whatever it is, as a shareholder, you will be rewarded for that business growing. Okay. So you have to take a step back and say to yourself, are we really going? Is the sky really falling? And all the Twitter and the whatever social media you're on, that everything is oh my God, the world's coming to an end. The world's not coming to an end. Nothing's going to happen. Okay, so you have to take a step back and not be the panic. Okay, don't be sitting there thinking that you're going to just short everything to oblivion, everything's going to zero. That's also not going to work, because if you're betting that everything's going to zero, doesn't matter how much money you're going to make. That means the world came to an end. Meaning, if Home Depot, Coke, Pepsi, Caterpillar, Boeing, all these companies that Apple, Microsoft, that keep the world going, go out of business, that means the whole world came crashing down, and money's not going to mean anything anyway. So, it's great to catch moves on the downside. I'm not saying not. Listen, it's a lot faster, it's a lot more exciting. I get it, but at the same time, you have to keep a level head and understand what is going on, what is the dynamic, what could be, what could not be. I think that the expectation for people when Trump came into office was that this thing was just going to be Trump 2.0, and we're just going to rip higher. He has a different agenda this time. His agenda is not the stock market. If anything, I would say that their agenda is really more the 10-year yield. That's really what they're looking for. They're looking to get rates down. That just appears what it looks between border and getting the economy under control. They appear to be really, really hyper focused on getting rates down. So you'll notice also he doesn't say anything. He doesn't say anything about Powell. He's very, very muted. It's very much tariffs and border, and he's really going after that agenda. Now, what's happening with his base? Again, a topic for a different discussion. Okay. So, with that being said, to a large extent, we've had our 10%. Could we go down more? 100%. Could we get down to this 5,400 level, which would tie into the September lows? It is definitely, definitely in the cards. Are we going to get down here to the summer lows? I doubt it. I mean, anything's possible. It's what, 5,100. The low here is 5180, 5119. So let's just say 5120. Could we get here? We could. I doubt it. I sincerely doubt it. Something really has to go really, really wrong for us to fall another 500 handles. 500 handles would basically put us at 20%. I mean, the historical data is not in that, is not there, and the truth of the matter is companies are adjusting, so I don't see it. 5,400, it's possible, but if you look out from a more of a weekly perspective, really, you know you're not really falling apart. So I know it's red candles. I get it. I understand. You could say, oh, I get it. but you have to look at it from a much bigger perspective. From a much bigger perspective, we're not really, it's scary, but at the same time, it's not astronomically stupid. Meaning we're not down here and everything is the world's falling apart. Listen, tariffs have that extent. If everybody's going to start raising prices on each other across the globe, and we're a global economy, it's going to happen. Certain countries are not going to be able to withstand this. I'm just going to tell you to you like it is. So you also have to be aware of that also, that this could get ugly. Now, the thing that's bothering the market more than anything else is that it's one day on, one day off, one day tariffs, one day not tariffs, one day 25%, one day 50%, one day no tariffs. This uncertainty of what's going on is very, very difficult. So if you're running a business, it's next to impossible to figure out how are you going to run your business. Okay. Now, one more thing before we go on to the charts, because this whole macro backdrop is really important. Drill, baby, drill. This is not going to work. Forget about the economics of it from the companies, drilling and all this other stuff. Forget about that a minute. The issue at hand, more than anything else, is that the companies don't really have the cash for this. Chevron, Exxon, BP, Total, they're very, very, very well run businesses. But what have they been doing with their cash for the past 4 years? Buybacks, dividends. They've been borrowing money for buybacks and dividends to maintain buybacks and dividends. That's what they've been doing. Are they really going to make this investment, which could take years, and who knows what what the next administration is going to do? Are they really going to make this investment? Probably not. And they need the cash to support their buybacks and their dividends. So because of that reason, a lot of what pushes the market up is buybacks. So the buyback machine needs to be fed. So even though we're pulling back, I get it. The buyback machine is still on. So, and that only turns off right before earnings. So that's continuing. And you have dividends. So I don't know how realistic it is that these companies are going to just start, you know, pumping away and drilling away like it's going out of style just because there's a new administration in town. So just something to keep in mind. Anyway, so let's get to the market stuff because that's what you want to hear. Okay, so realistically, we've had our 10%, we've bounced. We're probably, I would say, constructively, if we're going to look to find some kind of a way to see where we are, I think we got to get up to like 5,800. I think 57 is going to be, it's just a bounce. It's nothing. Even 58, I think 58 is really your line in the sand. I think we're going to bounce through 57 relatively quickly and relatively easily. The question is, how much farther, and do we base out and then fall, or do we base out and go back up? What do we do? That I don't know. I think it's going to take not technicals. It's going to take a macro change for that to happen, whether it be tariff relief or um, I know Lutnick has been on, the Commerce Secretary has been on a lot of TV recently, a lot of news stations in the news, sorry, saying that they're looking to do, if they can get the budget balance within the next 2 to 3 years, a federal tax holiday on people making $150,000 or less. That could be a huge spark. Huge. If they could do that, they could find a way to balance the budget and then do a massive tax cut like that. Forget it. If you're a short, get out of the way. I'm just telling you facts. Just get out of the way. But we're, a good 2, 3 years from that even happening. Okay, if they can even balance the budget. Okay, so for now, um, be aware that S&Ps are very, very headline driven. The bounces are violent and vicious. Have your levels. I'm not going to put out levels because at the end of the day, we all see things differently, and what I see is different than what you see, and you can make arguments about up, down, sideways, and this level and that level. I don't want to play that game because to me it's just a big giant waste of time. Okay, just do smart things, like just normal smart things. So if you see here that you could basically line up to about 5650, and it's basically lining up with this somewhat cluster, and over here and this area over here, and it kind of lines up. Okay, so you could say, okay, this is kind of like an area. Can we get above this? Fine. Then obviously your next line in the sand would be, again, the 200-day 5,700. And then do we try and reclaim this low over here from January, and then afterwards do we get up to 58? I think 58 is probably where we're going to bounce to, and then try and figure out where we're going to go from here. Now 58 from where we are currently at 5638 in this market, we could do it in 2 days. So whatever you're going to do, don't fight. So if trade the market in front of you, not the market you want. So if the market's not is not doing what you want it to do, but it's doing something opposite, don't fight it. either get the heck out of the way or go in that direction, but don't fight it because you're going to lose. So that's the S&P. Let's just look at NDX. We're going to stick with market moving and some ETFs, and that's it because we have to just stick with what's moving the market. Okay, NDX, again, tech is getting hurt. Tech is not, tech kind of looks like the S&P. 18 and a half, that probably looks like it could be hit. We could see that. It's very possible. Again, clearly below the 200. I mean, it's not, this is, it doesn't take rocket science to see what's going on over here. Your first level you want to see is you really want to see us get above here, possibly get to 20,000, 20,001, and then see where we're going. Again, the bounce probably takes us up to about 20,004 in that area, and then we'll see where we go from there. Again, battered and bruised. Let's look at the NYSE Fang. I like that index. I like that index a lot. Okay, NYSE Fang happens to be that index is holding up better than everything else. Um, that's a dollar sign. It's holding up way, way better than all the others, as you can tell. So that's actually a good thing. Again, what's in it? What's holding it up? Apple. Apple is holding up a lot of these things because a lot of people are hiding there. We're going to get to Apple in a second. But the reason why the market's not getting completely annihilated is because people are hiding in Apple. Russell's going to be hurt because again, risk off. People are not going to be there. The rut looks like just trash. I'm not even going to get into it. If people think that the U.S. economy is going into a recession, the Russell is going to get smoked, which is exactly what's happening here because the Russell is domestic companies. If you don't know what the Russell is, read up on it. Otherwise, don't be trading it. Okay. The stocks again. This just looks yucky. I mean, there's no other word of saying it. There's nothing really here to even discuss. This is just. I'm not going to get into. I'm not going to waste your time on chart patterns. I mean, this is just yuck. Just plain and simple. This is yuck. Okay, let's get into the names quickly. Oops. Okay, Apple. Apple, even though it's coming in, Apple is holding up relatively well. People are hiding here. It's a quality company. It's got a quality buyback. It's got a quality dividend. People are hiding here. Okay. The only thing that changes the Apple trade is if, and this is something you got to pay attention to. I can't tell you this. You're going to have to do this on your own. You got to do your own work. If tariffs from China start coming out where they start attacking US companies, Apple, it's lights out for Apple. I'm just telling it to you, facts. If China comes out with something that they're going after US companies, 190 is probably not even where we're going to go. We're probably going to get down to somewhere over here in the 180s. Okay, so you're talking about a potential $40 to $50 move in Apple if China decides to retaliate heavily against these companies, and China can do it. Don't kid yourself; they can. Microsoft, let's take a look at that. Again, Microsoft, bent, not even bent, broken. They're all broken. They're all just the question is what's the least ugly from the broken? But Microsoft is broken. Let's go to the next one. Amazon, bent. One second. Amazon's faring up pretty well. Because people are buying the company sells product, so it's more like a Walmart. So even though it's Amazon, it has AWS, there is a little bit of safety in that where it is selling product that people need. So that's a good thing. That's kind of holding it up. Um, my opinion. Let's take a look. Google. Hold on. Google. I mean, again, these are all broken. These names are broken. You have to find the least, if you want to look to buy something, you're gonna have to look for the least broken. But broken, I know I'm gonna say, oh, he's telling us that just that things are broken. Not a question of that. It's a matter of finding the least ugly thing if you want to buy it in at the dance, and on top of that, being involved with things that actually make sense to be involved with. Okay, and also giving you a picture of why the market's moving the way it is. The FANG names, the Mag 7, account for 50% of the NDX and about 32% of the S&P. So if you want to know why these things are moving, this is what you got to focus on. Okay. Um, Meta holding up way better than it's probably the best looking chart out of everything, even though it's broken. I mean, they're all broken, but it's definitely the one of the better looking ones out there. Nvidia is going to be a disaster, as you all know. Nvidia, it's very sloppy, it's very choppy. I mean, there's probably better places to be. Are there trades in it? Yeah, that you can always find trades, but I am of the opinion that you should never look for trades. What you should be doing is you should be getting into trades where the market forces you to get involved. Okay. Those are usually the better ones. If you're just constantly looking to click buttons, it becomes a little bit more challenging. You want to be in the trades where the market's just forcing you, saying you got to be involved. Look at Broadcom quickly. Again, Broadcom also bounced off the 200, filled the gap like we had spoken about a few weeks ago. It's holding up relatively better, than Nvidia. We'll see how this builds out. Maybe there's a good buy over here. We'll see. We'll see what this looks like. Um, CrowdStrike looking, holding to a certain extent where it needs to. Let's see what happens when it gets back through into this like little monster of cluster. Yes, I TM'd that monster of cluster or cluster of monster, whatever. We'll see how this reacts. Let's just look at Netflix. Netflix again, filled the gap, holding up relatively well. Let's see if it can get back to this, it can get back into this 950, 960 area. I think it's possible if the market gets some kind of bounce. ServiceNow, again, um, just yuck. There's no other way of saying this, just yuck. Okay, let's look at some of the ETFs. XLE Energy, um, looking okay, looking okay. It's just choppy, but it's hanging in there. Um, you know, Friday was a stand up and take notice day, which is interesting because oil was not a stand up and take notice day, to be perfectly honest with you. So I'm a little shocked by this because oil wasn't really doing much, gasoline wasn't doing much, heating oil wasn't doing much, natural gas wasn't doing much. So the fact that XLE was outperforming like it was is actually pretty impressive. Um, let's just look at the OIH quickly. Um, Also interesting. This could probably get up to this 250, 260 area, probably. I mean, this 260 area, maybe even up to the 270 is possible. Let's look at XOP quickly. Don't really look at that too much. Again, it's interesting that a lot of these oil and gas ETFs had a stand up and take notice day when the actual underlying did not. Crude, like I said, crude didn't, gasoline didn't, heating oil didn't. I mean, natural gas was up, but not enough to affect like ETFs like it is. Let's go quickly and look at the SMH. SMH again, yucky. There's nothing really more to talk about here. XLF financials are holding in. I mean, it had a bounce, so everything's going to bounce. Um, Keep in mind that on an average day, about 84 to 87% of all stocks follow the general market. So if the market's going up, 87 to 84% of all stocks are going to follow along. Let's look at the TNX. Let's look at the 10-year quickly because we actually need to see that. That's your bogey. You need to know that. Again, that's holding. That's hanging in there. That is hanging in there. Okay. If this, you keep this on your radar. If this starts to, this is probably more important at this point than the VIX. Everybody focuses on the VIX. To be honest with you, I think the VIX is broken. And maybe I'll make a video on why, but I don't think the VIX is a good barometer. You need to focus on this. You need to focus on the 10-year yield. That's what you need to be focusing on. That's going to dictate what the market's going to do. Okay, that's it. I hope this was of value. Have a great week, and hopefully I won't have to do a midweek because the market didn't fall apart completely. Okay, take care. See ya.